Welcome to the Spring 2020 Economic Outlook and Forecast Conference from Cal State Fullerton. We are bringing this to you on April 22nd, 2020, as we promised. However, it is a virtual conference. Under the circumstances, there is no choice. But there are positive sides to this. You can watch it at leisure, at home, in your pajamas if you like, but you're going to miss out on the great lunch and camaraderie and networking with your friends. As in the past, Mira, Farka, and I will be presenting this together. We'll be switching back and forth throughout this conference. I want to thank our title sponsor, Commercial Bank of California. They have been consistent and ardent supporters of the Mihaylo College in Cal State Fullerton, and we're grateful for their support. Making predictions is both an art and a science. It's a difficult task under the best of circumstances. So in a time like this, one thinks of Yogi Berra and his famous quote, "It's tough to make predictions, especially about the future. And the future ain't what it used to be, so it's a tough task." Now, this virus has been like a ticking bomb or a wildfire that has gone throughout the world. About 185 countries report cases of coronavirus. Now, there are a few things we know about the virus, but much is still unknown. It's highly contagious, and often people don't show the symptoms even after they're affected. Its fatality rate is significantly higher than that for common flu, and we currently lack resources for extensive testing, without which data on infections and deaths is quite unreliable. Lockdown and stay-at-home policies seem to be the only means to reduce its spread and not overwhelm the healthcare systems. Now, to understand how virus has been spreading, we use a chart that is, you may have seen that earlier as well. On the vertical axis are number of cases in the log form, and in the horizontal axis are the number of days. The more vertical the slope, the faster the rate of growth. For example, the line on the left shows cases doubling every second day, while the next line shows cases doubling every third day. South Korea started out with a sharp increase, but then the curve started to bend once their measures became effective. And it became almost flat, which means that the rate of cases is barely increasing. It's gone down to almost zero. And they were able to do that through strict containment measures. Other countries had followed similar paths, but took much longer to bend the curve. Now, US has gone through a similar path, very sharp increases. US numbers are, of course, much higher because US is a much larger country, more spread out, but it has been able to bend the curve as well. Now, projecting the number of deaths is very similar to in terms of the graph that we have seen on the left-hand side. South Korea's curve, again, is bending much earlier, much faster than other countries. But other countries have been bending the curve for the deaths as well. And the US case is very similar to that, where the number of cases every day is starting to come down, the increase, though the total number will continue to go up for some time. When it comes to states, Washington State first reported the coronavirus case in the United States, but New York is the one that hit the worst. Other states, Louisiana, Michigan, and New Jersey, are the ones with the largest number of cases. Now, for California, it started a little bit later, and the California's curve has been lower than other states, fewer cases, even though California is much larger in size. California was one of the first states to declare an emergency and to institute lockdown and social distancing, and that is responsible for this shape of the number of cases. Now, similarly, in number of deaths, the story is very similar. New York is at the top, very large number of deaths. These numbers keep changing every day. These are good as of 2 days ago, but they will be updated on a daily basis. Now, California's case is very similar as in the case of deaths. Number of cases, the number of deaths has been declining, but still growing and will probably continue to grow for some time. Now, Orange County, they're the same kind of graph. or in other counties surrounding Orange County, San Bernardino, Riverside, and LA, the graph is shown here. They all have their curves bending somewhat because they're all instituting social distancing, staying at home, lockdowns. Now, Orange County has been able to do a little better. This curve is bending faster, quicker, and is getting to a point where the number of cases is becoming smaller and smaller every day. Number of deaths is the same story, very similar to what we've seen before, where Orange County has been able to bend the curve much earlier than other counties, and which is a good news for everybody, but especially for Orange County. The coronavirus seemed to affect people differently, depending on the age and sex. Here are some numbers from Orange County, for example. As you can see, most cases are concentrated for people between ages of 45 to 64, and then 65 and above. Also, men seem to be a little bit more affected by the coronavirus than women. Now, the story for the number of deaths is quite striking. Most of the deaths have occurred among groups of people above 65, and men more than women have succumbed to the coronavirus. This data has to be confirmed with a larger sample, but early results do indicate these trends. Coronavirus has caused such a devastation, both in terms of human toll and the economy, and the whole world has come to a standstill, seemed like a medically induced coma, and there hasn't been any precedent for that. We don't know what the future will hold, but the present doesn't look like anything we have seen in our lifetimes or even longer time frames. The only thing people can imagine at this time is a feeling of strangeness and isolation. And it's not surprising that your mind goes to The Wizard of Oz and the way Dorothy felt. We are not in Kansas anymore. No, certainly not. This does not look familiar at all. Now, stock market has been severely impacted, as one would expect, by the shutting down of the economy. The first case in the US was discovered on January 20th. By the 27th of January, when the Wuhan lockdown became known and extent of the virus became more widespread, the markets had shed 2.5%. But the real concern began in mid-February when it became obvious that the virus has spread to Italy and South Korea. By the end of February, the market had dropped 12%. Things snowballed from there. Italy announced a lockdown on March 8th. More cases were confirmed in the US. And when Saudi Arabia and Russia failed to come to an agreement on oil production, the market fell 7.5%. On March 11th, WHO declared it to be a global pandemic. Markets fell 9.5% that day. March 16th, the second Monday, the administration seemed to suggest that the virus may last at least through August. Market dropped 12.5% that day. It was only on March 23rd when the markets found a bottom. That's when it became known that the CARES Act would very likely go through. By then, the markets had dropped 35%. We had a real problem. There is no question about it. Now, this has been one of the fastest drops in history. Of course, the largest drop of the stock market happened during the Great Depression when the markets fell 85%. But there have been other incidents of market falling. For example, in 73, 74, it fell by 55%. In the dot-com bubble, when that burst, markets fell 41%. And more recently, in 2008 and 9, the Great Recession, markets fell by 57%. But the 35% drop in the present case is the sharpest. It happened in just barely 23 days. And as if this wasn't enough, a second crisis appeared, oil. Now, oil supplies have been pretty steady, but they oversupplied markets that they really were were further disrupted by a tiff between Russia and Saudi Arabia. The demand for oil had been falling late 2019, and coronavirus really led to a downfall. As a result, oil prices fell dramatically. Brent oil price fell below $20 for the first time since the Great Recession. Markets have been very volatile throughout this period. The VIX index that measures volatility shot up to the levels that we saw last in 2008 and 9. Now it has come down a little bit yet in the last few days, but still remains at a pretty high level. Panic has driven dollar higher because whenever there's panic, people go for security and safety, and dollar provides that. So the trade weighted value of the dollar has gone sky high, much higher than during the Great Recession. This is going to lead to huge problems for the developing countries that are already suffering from the effects of the coronavirus. There's no question that the world has been turned topsy-turvy from the effect of this virus, and it has been shaken to its core. To quote James Bond, it's not only shaken, but also stirred. Let me turn the story over to Mira.
Hi, everyone. First and foremost, I hope you and your loved ones are safe and healthy. Second, I know we're going through some unprecedented times, something that none of us have experienced in our lives before. But if there is a small measure of solace, if a smidgen of silver lining, so to speak, that I take out of this thing as an economist, is that for once, this crisis cannot be blamed on economists. This is not something we missed or we failed to foresee. This is first and foremost a public health crisis, not an economic crisis. Unfortunately, the longer this goes on, the more it's going to turn into an economic crisis. But for once, this cannot be laid on the doorstep of economists. We wash our hands off of this one. And with that, let's dig a little bit deeper into the forecast. First, let me start with a plea. Let me ask, but please don't shoot the messenger. I mean, some of the data and the forecast we'll share with you here today are quite disturbing. I mean, some of them are unprecedented in scale, and they paint a very dark picture, especially in the short run. So my plea to you will be, please don't shoot the messenger here. And you've heard a lot about Great Depression. We talk about the Great Recession. We're calling this the Great Disruption. So this is the Great Disruption. And yes, indeed, life is like a box of chocolate. You never know what you're going to get. Unfortunately, this time around in March, we ended up with a very bitter, somewhat poisonous chocolate that will not only make us sick for a while, but will also leave a lingering bad taste for quite a while, actually, for quite a long time, as we will discuss. Now, that's because this pandemic has hit both the demand and the supply side. I mean, this is both a demand and supply shock. And first, it started as a supply shock, as governments across the world have decided to literally take a sledgehammer to a microbe that is literally 1/10 of a thousandth of a millimeter. They've issued an array of lockdowns and shutdowns orders and so on. If you look at the US, for example, as of March 20th, if you look at the number of states under lockdown, only 4 of them were in lockdown, California being one of them, one of the first ones to institute a lockdown. The rest were not. But by April 3rd, 38 states had issued a lockdown. About 7 of them are now under partial lockdown, and only 5 have no lockdown or shutdown orders. And there has been, in a sense, there's a huge variation across states, in a sense. There's been sort of a hodgepodge of orders. But in general, all 50 states have seen school closures. 45 has closed businesses. 29 are implementing masks when you're in public. 27 have some sort of travel restrictions. 15 even have instituted some state and local curfews. So if we were to be invaded by Martians today, they would find out that Earth is literally closed.
Now, no one doubts that we are certainly in a recession. The question is how deep and how broad and how long. How black is this swan? And so when we talk about recessions in general, we look at 3 things, sort of 3 factors, so to speak. One is the depth. The second is the dispersion or the breadth. And the third thing is the duration of the recession, the 3 Ds, so to speak, right? So when it comes to speaking in terms of depth and breadth, from a supply perspective, this recession is certainly very deep and very broad. I mean, if you look at simply the number of small businesses closed, I mean, the vast majority of them are closed. Beauty and personal and leisure and entertainment, over 90% have been closed down. Restaurants are only operating as a takeout place. But a bunch of other sectors, the shutdown is sort of stretching across all sectors, including home and repair, retail, professional services, and so on. So there's no surprise then that revenues have cratered in almost all of these businesses. So if you look, for example, at lodging, their revenues are down 86% compared to a year ago. Same goes for bars and restaurants. That's between 50 and 60% sort of decline. Retail is close to 30%. Now, it shouldn't come as a surprise that grocery stores are doing fairly well. Their revenues are up by 41%. But here's another category that's done very well, gun sales. They're up about 93% compared to last year. Now, if we do a very quick sort of a back of an envelope calculation to see how much of a share of a GDP is lost because of the shutdown, we calculated about 32% is lost. And if you want to translate this in terms of real dollar amounts, that's about $580 billion a month, almost $600 billion that is being lost due to the shutdown. Now, what started as a supply shock has unfortunately morphed into a demand shock. If you look, for example, at unemployment claims, I mean, they were averaging about 230,000 per week in January, February, and first part of March. These are very low numbers by historical levels. But of course, they shot up, as everybody knows, to nearly 7 million over the last 3-4 weeks. Now, this is by comparison, the highest peak we've seen before in unemployment claims was about 700,000 during the height of the Great Recession. So these are 10 times larger than that. If you count them all up, we lost a total of 22 million jobs in 4 weeks. For context, it took us 10 years from January 2010 to add this 22 million jobs. So we lost them very quickly within the span of 4 weeks. If you look in terms of job losses, they're concentrated in the low-wage earners. 92% of them have come from low-wage earners, about 8.3% from the middle. And in fact, the high earners have actually increased they've seen their ranks increase by about 0.3%. Now, most likely, a lot of these workers are furloughed rather than laid off for good. So some of them will be hired back when things reopen again. Vast majority will be rehired. But as we discuss further later on, we do project that some jobs will be lost forever due to the fact that some businesses may never reopen. Now, we've learned a new definition of work, and we know that it can be categorized as essential versus non-essential. Now, we know who your essential workers are. You've got your healthcare workers, the police, the grocery store, the delivery people. There's a couple of what I would call somewhat questionable, dodgy categories. Government is deemed 100% essential. I guess it shouldn't come as a shock that the government did categorize itself as essential. Another category that is entirely essential is marijuana. Marijuana sales are through the roof during this period, 160% increase in California alone over the last few weeks. I guess I'd be the last one to gripe with this as we have been quarantined over the past month or so. Now, who are your non-essential workers, you say? Well, you know who they are. Anil and I have been quarantined for the better part of a month. We decided it kind of feels okay to be non-essential. It's a little bit liberating to a certain extent, I must say. Now, if you want to understand the depth and the breadth of this of the labor losses, so determine how many jobs, for example, are at risk due to the shutdown, you could look at two things. I mean, it's worth to look at the two categories. One is essential versus non-essential, and the other one is the ability to work remotely. So looking at this shutdown orders, we took a back of an envelope calculation, and we figured out that about 58% of employment are actually deemed essential. So 58% of employees are essential. That's about 88 million. Of the remaining non-essential workers, so 42%, which is about roughly 64 million people in the US, some of them have the ability to work from home. Only 30% can work from home. That translates to about 19 million workers. Now, of course, this has a very high, this varies greatly with the type of industry. The Bureau of Labor Statistics have a survey that asks exactly, responds precisely the question, what is your ability to work remotely or to work from home? And as you would expect, in large part, this is concentrated to financial activities or professional and business services, information. So these sectors have more ability to work from home, less so in manufacturing and other services, and of course, really low ability to work from home if you're in leisure and hospitality or transportation and utilities. So these non-essential workers who cannot work from home, 70% cannot work from home, this translates to about 45 million workers. And these are your 45 million workers whose jobs are still at risk. Now, if you want to do a further calculation and you want to project the jobs at risk by the type of industry, we actually came up with the following estimates. So leisure and hospitality tops the list with 12.6 million jobs at risk, followed by professional services with 8.2 million. And of course, wholesale and retail, 7.5. So these are the top three categories with the most jobs at risk. At the bottom, rounding the bottom, is transportation and utilities, largely because they are actually categorized as essential. If we want to do this calculation for the local economy, so we look at the Los Angeles area have about 1.13 million jobs at risk. Orange County, 420,000 jobs. So that's around, just to give you a perspective, during the Great Recession, we lost 157,000 jobs in Orange County. At risk now is a bit more than double that. And in Inland Empire, jobs at risk are about 520,000. Now, our projections show that the unemployment rate for the US will reach about 17.4%, and that will happen sometimes in May of this year. So the recession is deep and broad, both on the supply and the demand side. But the biggest question, the most important factor is actually duration. I mean, the longer this goes on, the more painful it will be. Now, if businesses treat this as a natural disaster, then the results could be sort of most likely the effects will be temporary and disappear quickly. For example, here we have Texas employment rolls after Hurricane Harvey and Florida employment after Irma. I mean, you see a quick dip right after the storm, but then no long-lasting effects. The employment rolls pick up very quickly right after. But there are cases when bigger natural disasters, in a sense, reveal deeper cracks in the system. Louisiana employment roll after Katrina is one example. It took roughly about 3 years for employment to get back to its pre-Katrina level in Louisiana after the storm. So we do think that COVID-19 shock, being that it's so deep and so broad, will behave more like Katrina-like. So follow sort of a Katrina-like pattern. And not only that, but it will reveal cracks in a system that are there, that have been existing there for a while. As we'll discuss later, for example, corporate debt that has been very high will be revealed from this crisis. But more importantly, we don't know the duration of this disaster. I mean, that duration is unclear. As Dr. Fauci, who practically seems to live in my TV and in my house every day, has succinctly said, you don't make the timeline, the virus makes the timeline. So the timeline is a bit unclear, and that's what's making this situation very uncertain. Now, for our forecast, we have to make some assumptions, and these are based most broadly on what the public officials have been saying. We do assume that sort of the grand reopening will be sort of fragile, fitful, partial, non-synchronous, different places opening at different times. We're also assuming that they're going to be reopening under strict conditions. More testing, social distancing will continue for a while, and restriction on large gathering will also continue to in places. In terms of the virus timeline, we assume we're going to have some kind of therapeutic drugs by the late summer, targeted antibodies by fall, but we won't have a vaccine until probably mid-2021. And there's potential of resurgence of the virus in the fall and the spring. So the duration is one of the main issues when we're forecast forward. The other thing that will determine the shape of this recession and as well as the recovery is the policy response. And here is Anil with the policy response.
The depth of the recession and the shape of the recovery depend greatly on the policy response. And here the response has been swift, broad, and substantial. Unlike in the Great Recession, when fiscal stimulus took months to pass, Congress passed 3 quick acts in rapid succession. The first, phase 1, was a smaller $8.3 billion bill, focusing mostly on bolstering research and testing for the virus. $3.4 billion went to the public health and social services. CDC received $1.9 billion, and the National Institute of Allergy and Infectious Diseases received $836 million to conduct research on therapies, vaccines, diagnostics, and other health technologies. Other agencies received $500 million, and international efforts received $1.6 billion. Phase 2 was a larger $172 billion bill, focusing mostly on workers and families. $105 billion went for tax credit for paid sick and paid family and medical leave. $56 billion went to boost states' Medicaid programs. $7 billion went for food stamps, 2.5 were appropriated to different agencies, and a little bit went to unemployment insurance. However, it became very quickly apparent that we really needed a bigger boat. This would not do. On March 17, the CARES Act was signed into law. It was the largest stimulus bill since World War II, worth $2.3 trillion. $510 billion of this bill went to corporations, airlines, Boeing, USPS, you name it. Plus, the remaining $450 billion will be used to support $4.5 trillion in loans to businesses through the Fed. $350 billion went to small businesses in the very popular program PPP, Payroll Protection Plan, at very low interest rate loans that could be converted to grants and forgiven, actually. $290 billion in one-time checks that would provide tax rebates of $1,200 per adult and $500 per family. $280 billion on business tax credits and $260 billion to expand unemployment benefits. And $180 billion to hospital and public health, some amount to aid to states, $72 billion to air carriers and air contractors, and $45 billion to FEMA. Additional $42 billion to safety nets and $32 billion to education. So to put this all into a historical context, the stimulus back in 2008, 2009 was around 5.9% of GDP. This stimulus that passed just a few weeks ago is about 10.5% of GDP, a really significant amount. But in the meantime, Fed has also gone all in, whatever it takes. The Fed has sprung into action, aggressive action, not only adopting policies used during the financial crisis, but expanding and extending programs in a way we have never seen before. It immediately cut interest rates to zero, lowered the discount rate and capital requirements. It also resumed quantitative easing, a program first adopted at the height of the last crisis. It first committed to purchase $500 billion in Treasury and $200 billion in MBS, but then made the program open-ended. It also resumed forward guidance. But unlike last time, the Fed now is actively involved in direct lending to corporations. On April 9th, it announced a radical expansion of the program, announcing $2.3 trillion in additional support. $600 million will go to Main Street lending, offering 4-year loans to businesses. The Fed will defer principal and interest payments for 1 year. The Fed will also be providing support to Small Business Administration's PPP program that we just mentioned. The Federal Reserve will support this through generous liquidity support to financial institutions that participate in the PPP. In particular, the Fed will extend credit to these institutions at only 35 basis points. Fed will also purchase $750 billion worth of corporate bonds for the first time to support the funding of that market. It will buy up to $500 billion worth of short-term notes issued by states, counties, and population of at least 2 million people, and the cities whose population exceed 1 million people. Well, there's nothing like this that we have ever seen before. And in fact, even that may not be enough. We might see more on the horizon. But the Fed's actions have paid off. Here we have A2P2 spread, the spread between high quality and low quality 30-day non-financial commercial paper. The plumbing started to seize up in mid-March when the stock market fell and A2P2 spreads rose dramatically. However, it began to reverse course on March 23rd when Fed first announced measures to unclog the market. The spread fell even as the Fed expanded policy on April 9th. The same can be seen for AAA spreads and BBB spreads. The BBB spread is still significantly above the mid-March level, showing strains in this segment of the market, but it's coming down and moving in the right direction. But is this enough? Will more be needed after all that we have done so far, all the Federal Reserve Bank and the government has done so far? First, the PPP program for small businesses was budgeted at $350 billion. But monthly expenses for small businesses are around $282 billion, 225 of which go for paycheck. So clearly this fund will last only about 5 weeks, but the fund has already run out of money as of last week. It needs more. Everywhere businesses are clamoring for more money, and this need will have to be met pretty soon. Also, the wage bill of 45 million workers at risk that Mira was discussing is roughly around $900 billion. Individual checks are $290 billion. So some help will come from unemployment benefits for those who lose their jobs. But again, there's a huge gap here as well. So what might a phase 4 packet look like? We think another $800 billion is needed, around $300 billion for the PPP program that we already mentioned. Another $100 billion is needed to gain support in Congress to extend unemployment benefits until early fall. And state budgets are in tatters, and it's likely that they will need cash fusion around $200 to $250 billion. Now, this may happen in phases. The latest discussion in the Congress indicate that a package, but much smaller, $450 billion is likely to pass this week. But as large as these packages have been, it's incorrect to call them stimulus packages. These are more like support packages meant to tide over the immediate needs. Much more will be necessary down the road.
Now, what is our outlook? We know this is a very deep recession, but what is the shape of the recovery? Well, we think that what started as a temporary shutdown will leave some permanent damage, some permanent scars. Not everything that was lost during this deep freeze will be regained back immediately when we reopen. And there's a couple of reasons for this. First, the reopening will be tentative and gradual and slow in some parts, right? And the second is that some damage would be really hard to reverse right away. Take, for example, consumption spending. Consumption retail sales have completely collapsed. They fell by 8.7% in March, the biggest monthly decline since the data started back in 1992. So it turns out that basically after we hoarded all the toilet paper we could find, like Elaine over here, Americans went back home, locked up, and never looked back. Now, looking back historically, we have some bad quarters of consumption spending, but we have to go all the way back to 1950s to find them. So we have a consumption collapse over 10% back in the recession of 50 and 51, another bad quarter in 1980 during that recession. But all of these pale in comparison with what we expect to be the second quarter numbers for consumption this time around. We are forecasting a very deep decline, about 30% in the second quarter. Now, granted, this will likely be followed by the largest bounce back we've ever seen in history. Third quarter will be great. That's because there's a lot of pent-up demand out there for virtually everything. A trip to the barber, a trip to the hair salon, a trip to the nail salon, to your favorite restaurant. But even so, we think consumption will reach its pre-COVID-19 levels only by the end of 2021. Take another sector, for example. Car sales are in for a tough time. They collapsed by 34% in March, and we're not even done yet. This was just the beginning of the lockdown. Durable goods usually do, and big ticket items do fare quite badly in uncertain times. I mean, they're very cyclical. People put off spending during uncertain times, and we're truly living through the mother loads of all uncertainties. Car companies know that they're hunkering down, they're girding down for harder times ahead, and some of them are in okay shape. Ford, for example, has about $34 billion in cash on hand. GM about 23 billion, Fiat about 17 billion. So they're in better shape now than they were back in 2008, 2009 recession. But certainly, this may not be enough. I mean, some of them are actually drawing down credit lines. Fiat, for example, has drew down its credit line about $15 billion. It actually issued about $8 billion in junk bonds just recently. So more is needed. And moreover, they've stopped producing cars and they're making ventilators. Ford is making about 50,000 ventilators. GM is making about 10,000 per week. And here is your brand new ventilator, complete with OnStar. It's actually quite snazzy, if you ask me. My only request is that should I ever need a ventilator during this period, as a long-term Corvette driver, I would ask that you please not hook me up to a Ford ventilator. That's all I would ask. Now, small businesses, and particularly contact-intensive type of businesses, things like hair salon, physical therapists, restaurants, are also in for some tough times. First, a large number of these have very small, sort of very little operating margin. A survey from National Federation of Independent Businesses asked these businesses how long they can operate under these conditions. And 50% said that they could operate less than 2 months. 31% they had margins to go on for 3 to 6 months. So a huge chunk of these may actually not survive the longer this goes on. Now, restaurants are in particularly tough shape. Open table reservations have plummeted to zero. The National Restaurant Association estimates that the entire industry would lose about $225 billion over the next 3 months and lay off about 6 million workers. Now, many of these restaurants are likely to close their doors for good. About 15% have either done so or will do so by the end of the month. And even if we reopen, right, the fact that we're reopening with a 6 feet economy, with this social distancing, rebooting some of these businesses in a 6 feet economy is going to be very difficult, especially for these contact intensive type businesses. They may have to operate at 50% capacity or so. So I worry that, and I hope we're wrong, but I worry that some of us may not get our soup at our favorite restaurant should this situation last for much longer. And of course, no industry have been harder than air travel during the coronavirus crisis. The total number of TSA travelers through TSA has plummeted. It was 2.2 million in 2019. That's 2.2 million per day. It's dropped to virtually nothing now. Of course, airlines have seen their market values drop by 62%, 65% or so. They've reduced their flight capacity by 65 to 70%. Rough estimates show that the industry will lose about $250 billion in revenues this year. And again, the 6 feet economy will pose further challenges for this industry going forward once we reopen. Now, on the positive side, it may mean you can finally stretch in peace. You can finally get that full entire row of seats entirely to yourself. But it certainly will mean operating losses on the side of the airlines. However, there are a couple of glimmers of hopes here in terms of the airline industry. First, the CARES Act earmarked about $50 billion in grants and loans to U.S. airlines. They're also eligible for 6 months of payroll, which is most than any other industry. Second, if we look at China, which is kind of 6 weeks ahead of us in this pandemic, but if you look at China as a guide for air travel, we noticed that travel to China fell by 75% in early February. but when the country went into a lockdown. But a month later, the number was only down about 43%, which means that some of the passengers had returned. Some of these are lured by rock bottom deals, obviously, but some passengers did return. So these are a couple of good news for the travel industry going forward. More concerning is the fact that this pandemic will likely expose deeper structural cracks in the system. And one of these that we've warned about for quite some time is corporate debt. If you look at corporate debt as percent of GDP, it has certainly skyrocketed. It's about 74% of GDP, the highest we've ever seen historically. Now, 7% of bonds are issued by corporations in sectors that are very hard hit by this pandemic, hotels, the energy sector, and so on. Another problem is that about $3 trillion in this debt is short term. It's about 3 to 6 months. So it's due to be matured very soon. In the words of Hemingway, how did you go bankrupt? Gradually and then suddenly. Of course, this has been a brewing crisis for quite some time. Since 2008, actually, corporations have issued around $1.8 trillion in new bonds each year. This is double the rate prior to the recession. So this is in large part due to the rock bottom interest rates, of course. Now, another source of concern is the quality of the debt. In fact, the health of the balance sheet of the corporation is a huge concern, and we warned about this before as well. If you look at the corporate bond debt by rating, about 3 trillion of them are investment grade, so A and above. However, another 3 trillion are B rated, which is just a notch above junk. And actually 1.3 trillion is in junk bonds. And this doesn't even include the most recent surge in junk bonds and that have occurred since the coronavirus shut down the whole economy. Now, maturity of this debt is also another concern. If you look at the investment grades, about 400 billion are due this year, about 461 billion due next year. In junk bonds, 87 billion are due this year, roughly 200 billion next year. Now, the problem is that revenue losses may lead to defaults. We would not be surprised to see losses of 60% in some sectors. Basically, this will take us from a liquidity crisis in which we are currently into a solvency crisis. Now, the bigger question is whether business failures could lead to a banking crisis. Corporations have drawn down their bank credit lines by nearly 200 billion in March since the crisis hit. If all firms borrow, that would come up to draw down all their credit lines, they'll come up to about $700 billion that the banking system would have to be in hook for. Now, the question is, can banks handle that? And there's actually some good news here. The banking system is now in a much better place than it was back in the financial crisis of 2008-09. So the banking system could be part of a solution rather than a problem here. To start with, the exposure, for example, to mortgage loans back in 2008 was about 44%. So banks held that kind of exposure. However, exposure of banks to business loan is a bit less, is about 32% currently. Also, if we look at the non-current rate for business loans, so these are business delinquencies. So of course they move up during recessions. If they were really high, probably the highest we've ever seen were in 1991. During that recession, they were 5.5%. And that's largely because of the severe downturn in the commercial real estate market. But other recessions have seen increases. If we assume that things get worse here and we assume a 10% delinquency rate, which is double the one we saw in 1991, that would mean that banks would be on a hook for about $400 billion. And the question is, can they handle this? Well, banks are actually very well capitalized now. I mean, this time is indeed very different. They have a capital buffer about $1.9 trillion. They can dip into a liquidity buffer, which has another $2.7 trillion. So banks are actually much better capitalized. In fact, if we look at it in terms of the threshold requirements, they're capitalized well in excess of those threshold requirements put together by the Office of Controller. If you look at Common Equity Tier 1, for example, the threshold is a 6.5% cushion. The banks have double that, basically about 13.8%. And the same goes for total risk basis. If you look at it on a total risk basis, if you look at it for core capital, almost double the threshold. So we don't foresee a banking crisis, at least given where we currently are. Now, what does it mean for the shape of this recovery? Will this be a V-shaped recovery? Will we have a quick drop and a fast recovery? Will this be a U-shape where we drop and we linger at the bottom for a while and then we recover? Or will it be an L-shaped recovery, which is pretty much a depression? Well, we think this is going to be mostly a W-shaped type of recovery. Here we have our GDP forecasts brought to you literally by letter W. Originally, we think that once the restrictions are lifted and the economy reopens, we will see a surge in rehiring, a pent-up demand. So you see that V, sort of almost a V-shaped recovery in the third quarter. However, that's not going to be enough to get us back to where we were pre-crisis. And we think that some damage will persist and will take a while to repair. It will take us till the end of 2021 to basically get more or less back to where we were pre-crisis. In terms of real GDP numbers, we look at this year, we're going to book a loss of about 4.3% in real GDP growth, and then we grow by 2.2% in 2021. For unemployment rates, same thing. We see a spike in unemployment in the second quarter. You see 14.2 here. That's the average of 3 months of the second quarter. And then a sharp drop whenever we reopen and everybody gets rehired again. But high unemployment rates will persist for a while. We've envisioned higher employment rates to remain in place all the way till the end of 2021 when we see unemployment being 6.2%. Now, in terms of annual averages, we envision a 8.9% unemployment rate for 2020 and 6.8% for 2021. Now, where does this leave us? Where do we see this going? First of all, let me just thank you for not shooting me. You guys have been real troopers. Second, since I started with Forrest Gump, let me end on a hopeful note also by Forrest Gump. And let's not forget that miracles do happen every day. Some people don't think so, but they do. We need a miracle right now. We need a medical miracle. Let's hope it happens soon. And with that, I thank you. I hope to see you next time in person, and I'll turn it over to Anil for housing and the local market forecast. Thank you.
In addition to the national sector that Mira just discussed, there's one other sector that we would like to talk about, and that's the real estate. It's a tough time for real estate, especially in this market and especially for the commercial market. In the last 3 weeks, mortgage applications have sunk in the 3 states, California, New York, and Washington. These are the states that implemented lockdown procedures before anyone else did. At the same time, there are a lot of bills in the housing market, in the real estate market, that need to be paid. For example, residential mortgages, $52 billion a month. Rents, $43 billion a month. Office rent, $10 billion a month. And retail, $20 billion. So if you add it all up, there's about $125 million worth of payments that are going to have to be made, with income being very, very uncertain, very unlikely. Now, in the case of housing, there's some little bad good news. The federal government, in the CARES Act, has provided for mortgage forbearances for 110 days, which can be extended for up to 1 year. That helps home buyers a little bit. The result, however, is that the applications for mortgage forbearances have skyrocketed. From about 0.25% from March 1, they jumped to 2.6%, 2.7% almost, by a month later in April 1st. Now, prices in the real estate market are a slightly different story for housing versus commercial markets. We believe that there is a little bit of a floor for housing prices. And the reason primarily for that is that housing supply is very restricted. So we believe that housing prices will be negatively affected by the coronavirus to some degree through next year, but then they will start heading up slowly. Commercial markets are a different story. Commercial market prices had been going up, and since in fact 2008 and 9, they've been on a tear, and I think they are going to get a much bigger hit. Partly also because businesses have learned how to do with less people, how to use online work. And real estate, in retail sales, consumers have learned how to shop online. So we believe that there will be double-digit price declines in the commercial market. Now, looking at Southern California, real estate has started to do very well at the beginning of this year after a rather tepid start last year in 2019. In Orange County, for example, prices in January, February, March were growing at 7.4% annualized rate after a 0.9%, almost 1% increase in 2019. Similarly, in LA, Riverside, and San Bernardino counties, prices have started to move up. But this virus is going to take the steam out of this engine, and we expect that prices to decline actually for the year as a whole before they start this slight upward movement in next year. Now, try to understand the Great Recession and its impact on employment is not an easy task at this time because there's a lot of uncertainty. So the only thing we can do is go back to the most recent major event, which was the Great Recession of 2008-9. And looking at that may give us some idea as to what to expect. For example, in January 2008, unemployment rate was 5% nationally with 7.6 million people unemployed. In Orange County, it was 4.4% with about 71,000 people unemployed. In the depth of the recession, unemployment rate jumped up between 9 and 10%, both for United States and for Orange County. It took 5 years until January 2015 for the rate to go down to the level of 5%. And then it took another 5 years to January 2020 right now, where unemployment rates drop in the under 4%. Remarkable improvement, but took a long time. We think that this virus, the impact of coronavirus is going to be at least as deep, if not deeper. And we'll come back to that in just a minute. Now, at the regional level, EDD provides data, but that's the only information that is currently available. Woods Center for the last 20 years has been conducting a survey of the business executives and asking for their expectations as to what is going on. And that expectation index we have found to be very helpful, very useful in predicting employment and unemployment rates. So in the most recent survey that was done in the third week of March, the overall index dropped sharply from 92.9 to about 22.7. That is the second sharpest drop, except for the 2008-2009 drop, which was under 20%. We expect employment, payroll employment, to also show drops, certainly for 2020 and maybe for 2021 as well, depending on how things evolve. But there's no question that employment will follow this index. In addition to asking several other questions, we asked business executives in Orange County what they expect their businesses to be doing in the second quarter. They have some information on the coronavirus as an impact. Comparing the first quarter of 2001 to the second quarter expectations, you can see a dramatic change from 60% expecting profits to be up, 77% now expect their profits to be down in the second quarter. The same story is true for sales figures as well. In the first quarter, 68% expected sales to increase and 24% expected sales to stay the same. For the second quarter, 72% of the business executives expect sales for their companies to decrease. And when it comes to hiring, the story is even worse. From about 90% of the executives saying in the first quarter that they intend to maintain or increase employment in their companies, and for the second quarter, 96% said they expect to have the same employment level or actually decrease. 50% of the executives said that they plan to lay off their employees. Obviously, a major shift from one quarter to the next. One company makes needs special mention for Orange County. Disneyland is the largest private company in Orange County. We did a study last year for Disneyland to measure their impact on the county. And we discovered that through directly and indirectly, in the Southern California area, Disney creates 78,000 jobs. 57,000 of those are in Orange County. Direct jobs are 22,000 in Orange County and 30,000 in Southern California. But it's had a major impact throughout the region. In terms of output, on an annualized basis, 3.7 billion of output is produced in Orange County by Disneyland and its operations and activities that it existence of Disneyland leads to. And Southern California benefits to the tune of $8.5 billion in total output. Not only that, Disneyland contributes substantial tax revenue to Orange County, $258 million, California, and particularly in Orange County, a major portion of the $258 million goes to the city of Anaheim, for a total tax revenue being generated by Disneyland of $510 million. Now, Disneyland is shut down, and there is no knowledge, no information on the Disney company when the Disneyland resort will be open. It may be months before it's fully operational, and that's going to be a major hit to both the county and its residents. Looking at the picture of Disneyland before COVID-19 and after shows you a completely deserted Disneyland. What a sad story, but of course it's unavoidable at this time. Tough times are ahead, and so here are our forecasts for Orange County in terms of employment. We believe that in the second quarter, average unemployment rate will jump to 11.5% from under 3% in the first quarter. Then it'll start declining, but it will not reach the level of 2.5–3% until after 2021. We believe that during the next 3 months, unemployment rate actually may go up to 15 to 17% for a month or two before it comes down. Our forecast for average unemployment rate for the county for 2020 is 7%, and for 2021, 5.3%. So it's a major hit to not only Orange County's economy, but nationally we see huge devastation of output. But America being what it is, we have strong belief that we will come back and come back stronger. Thank you for your attention, and we'll be back in the fall. Thank you.